Bank of Baroda up next. And Harsh, looking forward to the conversation.
Well, yeah, we have with us Mr. Debadatta Chand, who is the Managing Director and CEO at Bank of Baroda. Interesting because margins have come off sharply. I'd be curious to understand as to why that is so. Growth is holding up quite well. In fact, better than industry, 12% YOY growth in this quarter, roughly 3% odd on a sequential basis as well. So very, very healthy growth. Let me first start off, sir, by understanding from you whether this kind of growth clip is sustainable for you, 12% YOY.
Broad number basis, what the bank is working out is to have a sustainable business model, right? If you look at the growth in deposit advances, it's something not only strong this quarter, we also had a strong earlier quarters and consistently for the last many quarters now. So looking at the current scenario in terms of growth of deposit and advances, the growth has been fairly balanced this quarter at 11.8%. And earlier when we had given a guidance on the deposit for the full year at 9 to 11 and advances at 11 to 13. And if you look at the deposit in this quarter, rather we exceeded the guidance. On the advances side, if you look at the component of advances, the retail continue to grow more than 20%, like almost 20% for many quarters now. And that is something sustainable going forward also. Similarly, on the agri and MSME, if you look at the December quarter YY growth, it is almost 200 bps higher than the September YY. So there clearly we have the traction, clearly balance out the business model in terms of growing faster in these two segments. The only component where we slightly moderated is on the corporate loan. While saying so, corporate loan clearly mindful of the cost structure happening on the deposit. And typically the segment where we slightly moderated the growth is on the finely priced book, which definitely high quality. But these are typically refi transaction or something of a takeover transaction, right? So there we slightly went, moderated the growth. So on a full year basis, if you look at the corporate growth going to be more than 10%. The agri and MSME for the full year going to be 14% or in excess of 14%. Retail continue to grow at 20%. In that way, the guidance of 11 to 13% on the advance side, which we had given, I think we will be at the upper band of that, rather we'll be in a position to exceed that also. So going by the scenario that prevailing, and particularly this March quarter is something different because there is a liquidity measures, there is a rate stance expectation, and I think these are all positive for the banking industry. And that can typically put us into a very strong growth for the full year also. And as I said at the beginning, we are working on a very stable and sustainable business model. I think FY26 also will be clearly replicating the same growth model for the bank.
Right, but sir, the major concern where the street is concerned as well is with regard to margins. They've come up from 3.1% to 2.94% on a sequential basis. You've also trimmed your expected guidance band with regard to NIM from 3.1 to 3.2% was the band. Now it's 3 to 3.1. Where does it lie, and what's the context? How quickly can you get back to that 3% number?
See, that is what actually our earlier guidance to operate between 3.10 to 3.20, and now we are saying that because of the cost dynamics on the deposit market, will operate 3 to 3.10. So clearly my 9 months NIM is 3.08, right, at this point of time. So considering the current scenario, I think we'll be operating in the band of 3 to 3.10. Saying so, clearly there is a cost pressure which already we have seen not only for the bank, but all the banking players in the industry. At the same time, if you can optimize on the income side, then possibly we can sustain your margin. So in a scenario like that, we have demonstrated for 9 months that we can still operate in excess of 3% on the NIM side. And although we do have a significant global book where the margin is much less.